the Footprint course, Unit 7, Hiding Behind the Elephant. This is challenge day 10 of 30. In the following slide, we're going to focus on the art of goal setting, how to define and create a process for achieving your goals. And I'm going to explain to you how to make your goals more effective. So let's get into it. Now, most of you have got this. You did this wonderful thing called New Year's resolution, and you've written down a whole bunch of things you want to achieve this year, and by the end of January, guaranteed that'll be in a drawer somewhere, it'll be packed up, it will be collecting dust. Guaranteed. 99% of people, this is the case. Now, I'm going to show you a process to avoid having, just putting this into the cabinet after a couple of weeks. Now, where it all begins, alright, is you need to define what exactly is your New Year's resolution. What is it? Do you want to be a millionaire this year? Do you want to, finally be able to buy that Rolex watch? Do you want to, do your best time in a marathon? What is that exact goal? So it needs to be exact. You must write it down in layman's terms. I want to be a millionaire. I want £1 million in my bank account by the end of the year. Now, most people stop there. That's where they get to. They write this down, a whole bunch of goals, and that's where it ends. Now, I want to just show you a small way you can change your goal setting that will allow you to actually be able to manage and ultimately achieve those goals. So first and foremost, every single goal you have must in one sense or another be process orientated. And I'm going to show you, when I show you an example, I'm going to show you what I mean by process oriented. So for instance, if we take the first example on the list there, lose weight. Now, lose weight, there is a process that you can attach to that goal. Now, just writing down lose weight, that's not good enough. You have to physically create the process in order to lose weight. Now, we all know that the basic elements of losing weight is increased exercise and, manage what you eat. So straight away, you go and write down a list. You go and write down a diet, a managed diet that you follow step for step for step. If you do this, you are just that one step closer to achieving your ultimate goal. Now, the next thing, goals must be measurable. Why? Because when the times are tough, when you stand in front of that mirror and you're seeing no results, when, times are you're stressed, you want to be able to lean on those measurable goals. You want to be able to see some tangible evidence that actually I'm getting closer towards what I want to achieve. Those goals need to be executable. Alright, what do I mean by that? In other words, you need to be able to have as much control in your hands as possible to achieve that goal. Right? If you're setting goals that are out of your control, i.e., I need a promotion, I need get a nice wonderful tan, or you have to set goals that are executable, that are under your control. If they're not in your control, there's no point in setting that goal because you're just going to disappoint yourself. And lastly, make your goals simple. Simple will mean effective down the line. Now, a goal doesn't have to necessarily be lose weight. A goal could be for 2 months, I don't want to drink any alcohol. Something so simple. But ultimately down the line, the spin-offs as a result of achieving something so simple will be tremendous. Now, I'm going to go through my goals with you, and I'm going to show you how just one of these goals will ultimately make me a better trader. So as you can see there, I've listed 4 goals. Now, I've had these goals actually technically for about 5-6 months. All right. So the first 3, process, patience, and productivity. Those are 3 sort of live by goals that I have. Without these, if I cannot achieve these first 3 goals on a day-to-day basis, I will not be successful on a day-to-day basis. So every single morning, the first thing I do when I get down and sit down is I write down process, patience, productivity, and control. If I can achieve every one of these 4 things on a day-to-day basis, I am guaranteed to be successful on that day. I might not make money, I might lose money, but guaranteed I will walk out of the office and I will feel satisfied because I have achieved my goal. Now, how do these goals, how do I actually, what does this goal mean, in other words, and how can you use, things like this to achieve your own goals? So the first one, I'm just going to go through process with you. Now, when I write down process, what do I actually mean? Well, the first thing is that I have a routine. Every single day, I arrive at the office at the exact same time. It's 6:32 a.m. There's no surprise, there's no secrets. It's 6:32 a.m. That's the time I get there. So I know straight away, by the end of the day, I can sit down and then at 5 o'clock when I do my debrief, I can say, did I arrive according to my routine? And if I did, I give it a tick. Then I need to read the fundamental rundown. I need to have my breakfast at 7:30 a.m. I need to ensure I never lose more than 30% before the cash open, or 30% of my allocated capital. I need to take a break at 11:30 a.m. I have to do a debrief come 5 p.m. and I need to do some form of exercise at the end of the day or during the day. Now, if I achieve all 8 of these step-for-step, process-orientated little goals, mini goals, ultimately, I give myself the big tick, which is today you achieved your goal of process. That's all it is, guys. Every one of those 8 every one of those 8 processes are in my control. They're 100% my decision, my choice. I can measure them easily. I can see, did I actually physically, take a break at 11:30? If I didn't, well, I failed at achieving my goal. Can I execute them? Can I physically, at 5 p.m., sit down at my desk, write a debrief, go over my trades, have a look at the strategies execute? Can I physically? Yes, I can execute them. Are they simple? Well, there's nothing more simple than at 7:30 a.m. having breakfast in the morning. If I go through every one of these 8 things, I give that number 1 a tick, and I've achieved my process goal. That's all a goal is, guys. You have an end outcome. Of course, my end outcome is to make a lot of money. Of course, my end outcome is to do my job well. Of course, my end outcome is to, want to look good. But what am I going to physically do to get to that end outcome? How am I going to get to that end outcome? What am I going to do to make it easier for me to get to that end goal? You do that, you're on the path to setting not just successful goals, but actually finally, for the first time in your life, achieving those goals. So the strategy, the hiding behind the elephant, as you can see per the grid, this is it's a counter trend strategy. So we are going against the flow. It is a footprint standalone strategy, so you don't require any other tools to execute the strategy. And it is obviously a passive style execution. So again, we're not going to be aggressive. Rather, we're going to let the market. So again, with just like strategy 1, in strategy 2, these are the principles that you're going to encounter throughout this strategy. I will again illustrate this on the blackboard in the next couple of slides that you're going to watch on a video, and you'll get a better understanding of exactly which principles are required for hiding behind the elephant. So the next example we're going to illustrate of the next couple of slides will be hiding behind the elephant. Now, as we did obviously in Unit 6, we started off with illustrating the trade strategy, as well as focusing on the key principles that you can expect to see within that strategy, as well as the variations and the locations where that strategy will be most effective. Do bear in mind, obviously, we then will turn our attention to some practical examples, both static as well as obviously practical examples that are live. Now, this trade strategy, to start off with, is predominantly, I would say, a little bit more of a scalper's type strategy. Okay, so it's not really a great strategy for someone that's maybe a bit of a longer term time frame strategy, simply because all hiding behind the elephant is that the elephant is none other than a really large order. So a large order is providing liquidity to the market. We recognize that large order, we jump in front of him, and we look to simply execute and take advantage of that large order holding the market. Now, before I actually illustrate this in terms of variation, well, in fact, let's illustrate it. So what we're going to see, and the best way to depict this is through a couple of prices. So obviously we know these are the X's, and this is the footprint chart. So the market comes down to this price point, and suddenly around price point 80, 81, 79, we see a real pickup in volume. In other words, we have a high volume node. Okay, so really, really high amount of volume being traded. Now, note that in its own doesn't mean a great deal. However,
if we continue to see the market reloading, and this is quite important, so we continue to see a process of reloading, in this case obviously buying absorption, okay, that tells us that someone has got a much bigger order to fill on the buy side than the selling that is currently going on. Now, some of you might think of this as an iceberg. It's exactly what it is. Now, the thing is, identifying an iceberg is one thing, but executing and making money out of it is another thing. So, before we actually move on to the variations, let's just talk a little bit about some of the principles that you can expect to see. So, obviously, we spoke a little bit about balanced and imbalanced auction footprint process. Now, typically, you're going to see this when we do have an imbalanced process. Why? Because this does tend to occur at extremes. So either we extend on the previous day's low, if that's the previous day's low, so we extend on the previous day's low, and then we get an elephant sitting in the market, or maybe we have a very aggressive move in one direction, but it always tends to occur when we are in an imbalanced market context. Now, note, what we will see is a relatively high amount of volume. So you could be seeing just a relative amount of volume as the market sells off, and suddenly the volume will pick up. Why? Because the sellers have found a pocket of liquidity. Now note, this is obviously responsive price behavior. Do note, obviously, this elephant has more to fill. So what you will typically see is that you'll typically see the market or the sellers run into this elephant. They will then potentially extend on the elephant. So a lot of the time you do get an extension of the elephant. Now, it's crucial to get the extension of the elephant because it's this part of the process that ultimately identifies this as hiding behind the elephant. In other words, let's draw it again. So we get our elephant. The market then extends through him. Now, what happens after that extension is extremely important in observing and identifying this trade strategy. Okay, because what you need to see is you need to see that elephant step straight back in and initiate in the opposite direction. In other words, what's happened is he's absorbed at these prices, but he's got more to come sitting below the prices he's absorbing at. Okay, once we get below those prices, he simply initiates in the direction that he's buying. Okay, and that's effectively what hiding behind the elephant is. That is the elephant, but ultimately he's hiding behind his passive reloading. Okay. Now, in terms of obviously liquidity, as you can see, liquidity is provided. He goes from being a liquidity user. Okay, so note he's a user in the first example. He's a liquidity provider in the first example as the sellers come down to him, and then he becomes a liquidity user. Okay, so he first provides liquidity and then utilizes. Now, very often these do leave bad lows and highs. Okay, and this is obviously the second variation of the trade strategy. Because we know by definition a bad high or low, as we'll discuss in later in one of the units, a bad low or high does tend to extend. Okay, so with that in mind, just briefly touch upon the delta shading. I don't need to mention it. You're going to see a very aggressive, if this isn't a down move, a very aggressive red delta, red delta, red delta. If it's an up move, very aggressive blue delta. You'll tend to see probably lighter colors there, maybe even one last price with a dark red, as we said, last bit of absorption, and then you'll see quite a strong light colored reversal. Okay, now in terms of variations, it's very simple. Okay, if the trade strategy is to first observe the elephant, allow the elephant to be broken, and then see if he's hiding behind it, then the trade strategy is very simple. Okay, the first variation, if this is our elephant again, okay, if we break below him, once we get back above the base of that elephant, so if these were a 3-price elephant, once we get back above that price, we're simply looking to execute within those 3 prices. Okay, that is our entry point. We obviously have a stop below the previous extreme, and we're looking for a reversal in the opposite direction. Now note, obviously this is in terms of risk reward, this is not going to be the highest risk reward trade strategy you're going to get. You're simply just looking for a little flush in the opposite direction. Why, you may ask? Well, it's very simple. We know that by definition we've now left a bad high and low. Therefore, that low is quite vulnerable, in which case we don't want to be looking for too big a target. In that case, our second variation is actually the break of hiding behind the elephant. So, if we recognize the hiding behind the elephant, once we do start to turn over and we do get below, for the second time we get below that elephant, we are simply looking to sell for a continuation in the direction of the trend. Okay, those are two variations then, and those are our principles applied. Now, let's go have a look at some of the examples on the footprint so we can get a better understanding of what it looks like. Okay, so our first example is in the E-mini S&P. And as you can see, it's quite an obvious elephant. We break below. We can see a nice little double bottom on the low. This was taken from the 19th of December. It is also a rotational chart. Bear in mind, these elephants, you can see equally good on a time-based or a rotational-based. Okay, so what we can see, we come down and we get this really big elephant here. Okay, notice the comparison. You know, this is, I always say, and the tip for this trade strategy is ultimately, you know, learn what is large absorption in your specific market, because most people don't. Okay, but if we just do a basic comparison, can you see 13,000 contracts traded anywhere else on this page? Probably not. I think the next best is 7,000 over there, maybe 6,000. So almost double the amount of volume. And that's, you know, if you want to learn this trade strategy and be really good at scalping the elephant, you need to first identify what is relatively high volume. Once you do that, then simply just observing it, noting it. Step one is obviously noting the elephant. Step two, letting the elephant be taken out. And once we get back above that elephant, we want to then look to be a buyer at one of the four prices. Okay, we can see obviously the market does give us a fill at 87.25. Comes back a second time, gives us a fill there, comes back a third time, and even comes back a fourth time. Okay, so it does give you multiple opportunities. Do note, like we said, what we do not want to see is we do not want to see the market going below the elephant. So in this instance, obviously, we would have most likely been taking profit on one of these three rotations. Time is quite an important factor here. Obviously, because we're expecting initiative in the opposite direction, it shouldn't be taking that long. So what I would say, if this was a normal example and you weren't out, you would have most likely stopped out at that point. Okay, so that's our first example of a hiding behind the elephant. Now let's look at an example of another one in the oil market. Okay, so this is taken from the 20th of November in the oil. Again, note the elephant, and I'm going to show you a practical example of this in a minute. You're going to see what it looks like, how quick it is, but that's the iceberg order. Again, know what is relatively large volume. Okay, 2,100 contracts is extremely large volume for the oil market. Note how the market obviously comes down. It has a look below the elephant, comes back above the elephant, gives us the full opportunity. But note in this example, notice how the market obviously does go back below the elephant, and this is what made this very, very tricky, because it ultimately did go back below the elephant. Now, like I said to you, some of the traders would choose to have their stop below the low. For me, I prefer to keep it much tighter, so I'd like to keep it once it goes back, but I would like to keep it pretty much around where the base of that elephant is. What I will say as a general rule of thumb is when the market does come back off it a second time and retest the elephant, you want to see some speed reversal away from it. Okay, if you see that speed reversal, in that instance, you know, you want to ultimately be placing your stop below the elephant. What made this tricky was ultimately it was the very next rotation in which we came and tested it. So I think that's what made it tricky in this example, but ultimately we can see that the elephant did hold and the market did rotate higher. Okay, just in terms of basic observations, obviously we do note the very aggressive volume, the real pickup in volume and delta, and ultimately the cumulative delta on the day. Okay, now let's look at some one more example before we move on to the practical examples. So ultimately, again, what we can see, this was taken from the 14th of November. Probably not the greatest example, and I'll explain to you why. Okay. what had happened was, and again, this is why relative volume is so important, and why focusing on the delta is so important. So again, some might argue that 600 is quite a large reload order, but ultimately, if you get if you don't identify what is large volume or not, okay, you're not going to become very successful at this trade strategy. So I've put this example as just a random example I've taken from the oil, but what we can see is that it did come back. It retested this this really dark amount of volume traded here, and then continued to sell off. However, this is not an elephant. Why? Because an elephant needs to be at least bigger than one price. Okay, that's the first thing. And second, you need relatively high volume. Okay, so that's the two real key takeaways from this chart, and just make sure you learn and differentiate between the two. Now, one thing I do want to point out, be very cautious. Okay, be very, very cautious trading this strategy in roll week. Okay, in fact, don't even bother with this trade strategy. Why? Because contracts are rolling. You're going to see a lot of potential elephants, and a lot of them are actually not elephants. They just simply roll. So just bear that in mind. Also, things like OPEX. Things like month end, be cautious trading them. So as I mentioned, you're going to find this as extremes, at the break of extremes, and you will see this as we go through examples. You will see what this looks like on the ladder in a minute. In terms of entry, I think the best thing to do is to go back to the previous example. As I mentioned, we're looking for an entry point somewhere within that original elephant, and with a stop either below the elephant or below the previous low. Okay, let's now go and have a look at two of the practical examples and see what they look like. Okay, so let's take a look at an example of the elephant. What you can see in front of you on the screen, between price point 80, 81, 82, we can see a real aggressive relative amount of volume being traded. Okay, so again, like I said, you can see almost a good 2,000 in this case, 2,600 contracts traded at 81s. A real elephant sat in the market providing liquidity. Now the market comes below the elephant, and you'll see once it comes back up above the elephant, this is the thing, is that the price response will be potentially slow below the elephant, but once it comes back up above the elephant, you should see it reverse quite quickly in the opposite direction. Now, before I move on, and I'm going to keep letting this play, in terms of targets, I think this is what's so wonderful about this whole course. A lot of the principles you learned are gonna aid you in determining targets and stops and all that, but we can very clearly see, note the imbalances up above. Okay, we can see a little bit of stop outs, we can see a real amount of imbalances. So for me, in terms of a target, I'd be looking for at least a fill back up towards this, double O's, maybe 01s, 02. So, we've got a good 20, 22 tick target here, and it's not going to cost us a great deal. Now, obviously, I mentioned in terms of stop, either you want it just below the elephant or below the low. So again, if you're looking for a 20 tick target, you could probably afford to take maybe a 6 tick stop, whereas if you're only looking for, say, a 5-6 tick target, you might want to keep your target a little bit tighter. Okay, so we can see obviously the market's now come back above those 81s, and again, what you're going to see now is we can see on the price ladder as well, but you can see now how the market's gone from being aggressively selling to suddenly more of an initiative in the opposite direction. Okay, note obviously in terms of execution, what we're looking for is we're looking for a retest of the elephant. Once the elephant is retested, as we can see here, all the way down to 80s. Okay, this would have been a good opportunity. 81s, note the absorption. Okay, so if you want to get a 1 lot or a 10 lot away, you'd easily be able to get filled in there. Note the market did break below, but ultimately did come back. But now, we spoke about in terms of the second variation of the strategy, what you would expect to see. And again, this is where, again, I try to give you guys as many variations, but always try to give you caution. If you're going to go with the two variations, you would have been a seller below 80s, looking for continuation with a tight stop, so maybe somewhere around 85s. If you believe firmly in the elephant, ultimately you'd still be long with a stop below the low. So it all depends on the variation you're applying. There's no right or wrong, guys. It's about you evaluating the strategy, understanding the strategy, learning the strategy, and then applying it. So let's just go through it. Obviously, we can see the second time we came back above the elephant, market then rotated quite nicely towards the upside, and ultimately we eventually went and filled out the imbalance to the upside. Okay, and obviously one last thing, do note the bad low. We will talk about this strategy a little bit later on, but do note the bad low there. You can see the market's traded almost 200 odd 229 contracts, or more like 260 or 275, apologies, and bad low, so we know there's a high probability for that to be taken out later on. Okay, so that's our first example. Now the second example is what happens when we get it wrong. What happens when we don't identify an elephant and we simply just getting sucked in? Remember I said the rules? You do want to see obviously at least more than one amount of absorption. You need to know what is high relative absorption. So I'm just going to show you the example of the picture we saw. So what you're going to see now is the market comes down to the 600 lot. I want you to see how the 600 lot trades. What you can see is on the price ladder, it is one order. Okay, so we can see on the price ladder here, it was just simply one order wanting liquidity there. It wasn't an elephant per se. Why? Because an elephant or an iceberg will tend to not show the whole order. He will ultimately tend to look to fill it up, and not show the market the entire order. Okay, so we can see obviously, the orders all got filled on the way down. Market came back up, and then the market continued low. So this is again what this is what an elephant doesn't look like, and I think that's the importance of showing this video. Just make sure that you follow the rules for identifying and observing an elephant. Alright guys, we're going to move on now, and we're going to go complete the template together. I'm going to go through all the key observations, strategy identifications, and execution principles in the slides ahead.
Now, the trading strategy of hiding behind the elephant makes a lot more sense to you. It's quite a unique trade strategy, but do bear in mind, obviously, it is a bit more of a scalp type trade opportunity with very good risk-reward metrics. Now, again, we're going to go through the template of it. Again, there's no right and wrong answer. Just a couple of answers and a couple of things I want to point out with you. Now, do bear in mind, obviously, you're going to see that as we go through all of these units, my answers are quite concise. You know, I try to keep things very concise and very to the point in these templates. And, you know, in the beginning, obviously, I want you to be as expansive as possible in terms of your understanding whilst you complete these templates. But over time, you're going to start to learn to quickly not just complete these templates, but also process what the information means. Now, we're going to start off again with a strategy observation. First and foremost, in terms of market context, you know, is this best found in trending or consolidation markets? Now note, I said obviously in trending conditions, be cautious, okay? Simply because when we do find an elephant in trending conditions, it can very quickly extend beyond that elephant. So we said we'd ideally like to see this more in a consolidation type phase, as is a much higher probability. Now do note, avoid this strategy in times of OPEX or rolls, simply because the price action and the liquidity being provided can be relatively misleading. Now note, in terms of balanced or imbalanced markets, we said we can find it in both, but the most important aspect to remember about the strategy is someone sitting there providing liquidity. The market extends beyond that point. Once it gets back above that starting point of providing liquidity, we see an extension in the opposite direction. It is that simple, and that's the key premise of this trade strategy. Now, in terms of trade location, ideally, we do tend to see this mostly at extremes. Why? Because this is a more obvious location for someone to step in and respond to higher or lower prices and ultimately provide that desired liquidity or be that elephant in the market. Okay, now in terms of market conditioning, some of the time frame participants you can expect to see, well, they are going to be large, okay, to provide that kind of liquidity. You do need to be a relatively influential, large participant. Ultimately, they are initially providing liquidity before taking it. So that sort of size can only really be a large time frame participant. Now note, in terms of liquidity, this is the key proponent of the strategy. This is what, you know, fundamentally underlines this trade strategy. So the tip, don't forget, was what is high relative volume. That's the key. You know, you can obviously learn to see what an iceberg or an elephant looks like, but it needs to be relatively high. And do note, when we obviously saw that relatively high volume that failed, do note that it can, you know, obviously, you know, you need to learn to differentiate between what's a good elephant and what's not a good elephant. All right, obviously volatility. Note, it's relatively subdued strategy in terms of volatility, as it is obviously more of a scalp type trade opportunity. Okay, let's now move on to the identification of the trade. So in terms of identification, we start off with the interaction. So what we can initially see, obviously, is this quite responsive type price action. Why? The elephant, or the buyer or the seller in this case, is responding to the lower and higher prices. They're absorbing the market. It extends through them. Once it gets back above the starting price of the elephant, or the base or the high peak of the elephant, we then get initiative in the opposite direction, i.e. The buyer or seller turns from being responsive to initiating. Okay, do bear in mind, obviously, it is generally quite passive interaction until such a time, obviously, that the market becomes aware of the elephant. It's almost a case of, you know, the market's relatively passive. It signals or identifies that elephant in the market and turns to relatively aggressive type price action. Okay, in terms of some of the key metrics, we spoke about volume, and we said obviously we will see large volume in and around the elephant, and we spoke about how interpreting this large volume is crucial to understanding the trade strategy. Note, timing is obviously of the essence. So in terms of identification, we start off with the interaction. So what we can initially see, obviously, is this quite responsive type price action. Why? The elephant, or the buyer or the seller in this case, is responding to the lower and higher prices. They're absorbing the market. It extends through them. Once it gets back above the starting price of the elephant, or the base or the high peak of the elephant, we then get initiative in the opposite direction, i.e. The buyer or seller turns from being responsive to initiating. Okay, do bear in mind, obviously, it is generally quite passive interaction until such a time, obviously, that the market becomes aware of the elephant. It's almost a case of, the market's relatively passive. It signals or identifies that elephant in the market and turns to relatively aggressive type price action. Okay, in terms of some of the key metrics, we spoke about volume, and we said obviously we will see large volume in and around the elephant, and we spoke about how interpreting this large volume is crucial to understanding the trade strategy. Note, time is obviously of the essence in terms of the reversal. Once we do get back above into that elephant zone, we do need to see quite a speedy reversal, so time is quite crucial. In terms of the delta, obviously very, very dark shades around the elephant, both to the upside and to the downside. In terms of the cumulative delta, again, no real significant importance. Why? Again, it is very much a scalp type trade. And then obviously in terms of relative change, we do tend to see the most relative shift comes in terms of the price dynamic. All right, volume and delta is not highly important in this trade strategy. It's more the color shading to show us the elephant, but then also the shift in price dynamic once we fail to extend upon that elephant. Okay, let's now move into the execution of hiding behind the elephant. Alright then, obviously with regards to execution methodology for the hiding behind the elephant strategy, firstly, obviously our entry point is passive in nature. We don't want to be aggressive simply because we're going for a relatively small winner. Obviously then do note our stop placement, slightly behind the elephant with the base of the reversal. Our target, like I said, a little bit smaller. This is a bit of a scalp type strategy. We're looking for a logical target, something like maybe a fill of the imbalance, or something a little bit smaller. So just try and find something that's a bit of an obvious type target. But again, always keep in the back of your mind that elephant's likely left a bad low and is likely going to revisit it. So just factor that in to the equation. In terms of risk reward, obviously because we're managing the risk quite tight stop, we have got relatively good reward metrics. Okay, application, we're going to be very exact here in process. We can't really afford to gamble over prices. Why? If we're risking, say, 3 prices to make 10 to 15 prices, okay, there's not a great deal of wiggle room there in which we can't be exact. So it's a very exact application in terms of execution. No need to preempt. In terms of leverage, we don't leverage on this. We don't even consider leveraging. We simply just take the increment out of the market. Now, in terms of a scalp, I always like to think of a scalp as nicking ticks. Okay, that's why a lot of our traders scalp the markets. Obviously, we like the big moves. We like to get on the big moves, the big breakouts, etc. But when the markets present you with a scalp opportunity with a high probability, we're going to nick those ticks effectively, and so should you. Okay, in terms of the tip for this strategy, learn what is large absorption in the market. We spoke about this quite extensively in the strategy. If you know what large absorption is, you'll know when there's an elephant in the market, and you'll be able to take advantage and nick some ticks. Now again, another one of my favorite books, The Obstacle is the Way. I think the title gives it away. What this book goes about is finding numerous obstacles and showing how within every single one of these obstacles, i.e. failures, i.e. difficult moments, there is always a way forward. Okay, and it's that understanding, that principle understanding that this book is all about. Now, note Ryan Holiday is the author. He's written a number of books. One of them, which is very popular, and we will talk about this later on in the additional reading, is The Ego is the Enemy. So in terms of a summary, this book ultimately transforms obstacles into opportunities. So it's just a mindset shift in essence. Okay, it shows you how most people think of obstacles as bad things. They think of them as, how am I going to get through this, etc., etc. But Ryan Holiday tries to dispel that and make you realize that every time there is an obstacle, through a little bit of a mindset shift, you can ultimately establish a very, very good opportunity from every one of the obstacles. Okay, in terms of action, again, this is very thought-provoking, and it's going to want you to adjust the way you think about obstacles in general. Now, some of the key highlights. Again, another process like we saw in Ray Dalio, obviously a step-for-step process to identify the opportunity in an obstacle. Okay, and this is key because sometimes, we can't always see the potential opportunity until much later on. So, nice step-for-step process. Note, obviously, it's going to show you how to manage difficult situations through a process of marginalizing. Okay, so breaking down obstacles into very small margins, into very small segments, is ultimately going to show you how to, get through obstacles. Then shift your mindset to accepting obstacles and aligning focus and energy accordingly. So in other words, rather than getting your back up with the obstacle, rather focus your energy on getting through it and getting beyond it. Then obviously the journey through a tough situation is ultimately what real growth is about. So he goes on then to focus on how, every time we do have an obstacle, ultimately we're growing from it. Okay, and then obviously all about failures again. We saw this in Ray Dalio. We can see this in most of the books, which is the principle of learning from your failures, learning the lessons from your failures. You're going to see me talk about this through numerous strategies. Most of the strategies I've learned throughout my career have come from initial failures. All right, that is then obviously the second book I would recommend for additional reading. Okay, we've come then to the end of Unit 7. This is the end of obviously Strategy 2. What I am going to say is obviously, again, you've been through this how to complete the drill process. Note, watch the drill in its entirety. Again, complete the template by yourself. Once you've completed that template, then go and watch the guided tuition. That's just to ensure that you are, gaining and growing in your own way with completing the template. Do note, obviously, you can see some stars there. What that's showing us is that the practical example, the drill example, will be the same one utilized in this unit. So you're going to go over the same example this time on your own. And obviously note, once you have completed your own template, compare notes to the guided tuition, make adjustments accordingly. And again, once you have confidence in your understanding and you're ready to then move on to the next unit, then do so. Now, do bear in mind at the end of every one of these units, you have got a day off. Utilize that day off. Make sure that you go focus on those drills and those principles and make the most of the day off. Obviously, then we finish off with our quote: "The guy who wins the race is often the one who does the least amount of work." Okay, this is so true. We see this time and time again, with all of our traders at Axia, our best, most established traders. It sometimes appears as though they work the least, but they're actually just working the smartest.
So welcome guys to the drill session. This is strategy 2, hiding behind the elephant. In terms of the product, we're looking at the oil. Do note, obviously this example was utilized within the unit session, which was unit 7. So we're going to go through it again. I'm going to just take you through the nitty-gritty of it, point out a few other things, and hopefully then you'll really understand and grasp the trade strategy 100%. So the first thing obviously is to look at context. We can see again delta on the day minus 10,650, and we can also see quite a negative delta forming on the current last 2 rotations. Note the volume, nice dark blue, showing us relatively large volume on these rotations. Do bear in mind these are 5-minute rotations. With that being said, we can see the elephant forming here. Okay, it stands out very clearly. We can see it not just as very dark colors, but we can also see it as very large numbers. Okay, so those 3 prices there, 80, 81, 82. Compare the numbers there. We're looking at 2,062. I mean, the next closest, bid absorbed there we've got is maybe 500. We've got a 600 there, so a really large, chunky amount of volume being transacted, being absorbed at 80, 81, 82. So that's our elephant in effect forming. Now note, we spoke about when we do have the elephant forming, we need to wait for a close of the rotation, for a little test or a little pop below. Once it goes back bid above the elephant, we want to look to execute. So right now we still have our elephant being formed. We would need to wait for that next rotation. Just a couple of factors. Note the imbalance. Okay, so we can see obviously very light volume, a great deal of imbalances. There were around 85, 86, 87. So again, in terms of target, we always want to look for natural targets for these elephants. Do bear in mind to the upside, we also have got a number of, again, low volume area, or also known as obviously sets of single prints there, maybe some stops with the zeros, or an imbalance in effect. Okay, so we've got an imbalance low volume area, which can be a very, very nice target for the elephant trade strategy. Okay. So that being said, let's then roll the tape a little bit forward. Let's get to that point of the next rotation, and then we can see. Okay, so the next rotation comes in. Now what we're looking for is we're looking for absorption in and around the elephant. We want to see a little extension below our elephant before we execute once it gets back above the elephant. Now, again, there's 2 ways to do this. Some traders tend to wait for a little bit of absorption so we can see the test the elephant here. Some traders do tend to get stuck in already here. That makes perfect sense. It's a little bit preemptive, but you know that you're in. So you'd be getting filled there, 81 bid. You now bid the market, and you would have a stop below the low. So we're looking at a 6-tick stop here, with a target somewhere around the fill of that little imbalance up at the top. It's double O's. So we're looking at a good 20-tick winner for a 6-tick stop. Very, very nice risk-reward metrics. So that being said, note the absorption. Okay, quite a lot of absorption here, 80, 81, quite a lot being transacted here. Really, really good price action sign. Really good interaction that you're seeing here. So there we go below the elephant. So the second variation or the methodology to trade is to wait once we get back above that elephant. So we're looking for the market to get back above 81s. Now, the reason some people do wait for the elephant or wait for it to get back above is because that confirms there is more liquidity to be taken by this elephant. Okay, so again, what I would say, this isn't an ideal elephant. Very rarely will you see this much volume being transacted below the elephant. More often, it's a case of we trade below it and straight back above it. That's normally how we would see the elephant trading out. Okay, that being said, obviously, we're now back at those 79s. If we were to get back into that 80, we'd be bidding ourselves at 80 and looking for a long trade. Again, this time, stop below the low. As soon as we start to move on sides, we can then obviously rotate that stop to just below that elephant. So again, waiting does have its advantage, which is that ultimately you get to use a slightly tighter stop. Okay, so we're now looking to get long. We've got our bids at 80, 81, looking for a fill. ultimately we've currently got to stop around those 74s. As the next rotation comes in and we start to drift a little bit higher, we'll rotate that stop to just below that elephant, which would be price point 79. Again, you're talking about here a 2-tick stop versus a 6-tick stop. If you preempt, you definitely will be in, and you will be able to take advantage. If you don't preempt, you might miss it, but that being said, you obviously do get the advantage of a much tighter stop. So it all depends, guys, in terms of how you execute. All depends. Okay, let's now have a look, and let's just roll this a little bit further forward again. Let's get to that next rotation. We've now got our fill at 80.81s, and we can see there our next rotation comes in. Again, the market comes down. Notice where it's testing, 80, 81, 82. That's our elephant. 11 lots trade at the 80, which is the base of the elephant. Again, now if you are in 80, 81s, you can start to look to move that stop once we take out those 85s. So once we clear those 85s, you can lift your stop a little bit higher and manage that risk. Okay, you don't always have to keep a stop static. You have to keep a stop where it makes a trade invalid. Okay, so this elephant is very much still a valid trade, but if we start to move higher and we start to move on side, we don't need to be taking the full kind of risk. We can obviously reduce that risk as the trade is starting to work in our favor. Okay, so we can see again we're just rotating within the range, and suddenly the market takes out the higher end of the previous rotation. Now at this point, we'll shift that stop up from 75s, bring it into 79s, almost at scratch. So a really, really powerful position to be in whenever you have a trade where effectively you get a free trade in a sense where the risk is either zero or very marginal. That's a fantastically powerful position to be in. But do note you have to work for that position. Okay, you have to really work on this trade. It's made you really focus in on your risk in order to get that effective free trade. Okay, now we said one of two things in terms of target. We either look for a logical target, i.e. maybe a fill of this imbalance up at the top here, or secondary, we're looking for the market to tell us when to get out. That's again, too many people are asking that question, where should I get out? Okay, you get out where the trade has effectively done what it should do. Now remember, hiding behind the elephant trade is very much a scalp trade. Okay, so we're not looking to be too smart here. We're just looking to take advantage of a price action phenomenon within the price, the footprint chart. Okay, so that being said, obviously we would like to get up to this target, and let's see what happens. Now we can see at the end of this rotation, market continues to drift higher. We've now got a stop at 79, and we can see the market just continues this process of drifting slightly higher and higher. Now again, as we get toward the end of this rotation, do note obviously we can then shift the stop even higher. So rotation's finished, we can now bring that stop up to the 84s. We can see that this market has now done a series of 3 higher lows. So again, whilst we're managing our target, looking for somewhere around those 56 double O's, if we don't get there, we don't want to be getting hit on a full stop. So again, we move our stop from 79s up to 84s, effectively meaning that regardless of the outcome of the trade, we will finish in the money. Okay, the market then comes down in the next rotation, and what we're going to see now is ourselves effectively being stopped out of this trade. Okay, so the market comes down, note, it takes out the previous low rotation. Now, again, it's so important, we would have shifted that stop again a little bit higher. We would have been stopped out at 87s, lock in a 6-tick winner. By no means going to break the bank with a 6-tick winner, but it's a 6-tick winner nonetheless. Okay, and that's why we manage risk. If you do this trade over the course of a year, and you do it say 20, 30 times, and you're taking in 6 ticks every time, okay, you're looking at a 180-tick winner. Okay, now on the smallest increment of $10, that's $1,800. All right, for a very quick, relatively straightforward strategy. Okay, so you can understand the power of obviously managing the trade, managing the risk, managing the targets. Now, just 2 other things I want to point out that are very interesting in this video. Do note, when we come back down to 80, 81, and 82, this is effectively where the market tests. Okay, so we can see the market comes back down again, tests that elephant, and straight away springboards, and we start to move higher again. Okay, so very, very interesting. You know, what I'm trying to point out here is the concept that markets have got memory. Okay, they don't forget these very key price points easily, so do factor that in. You know, the markets can hold those price points time and time and time again. Okay, the market then rotates higher, and we continue to move up the page towards that imbalance. Okay guys, I don't want to go too much more through it. Obviously we've seen the full extent of that video. You know, in terms of some of the metrics, I mean, there's nothing really too much important to point out. Do note the dark blue. Okay, so again, you know, a couple of telltale signs for taking profit. We could see, you know, that real dark blue. We hadn't kind of seen any kind of aggressive dark blue. We saw a little bit here, but we could see that once, twice, 3 times. So the market really, really reluctant to be too aggressive through this 95 area. Just something worth pointing out. Okay, that then brings us then to the end of our guided tuition for the hiding behind the elephant. Again, you know, go and find these strategies. They can give us some really good, unique scalp opportunities and some really relatively easy money opportunities. Alright guys, thanks for joining. I'll see you again back in Unit 8.